back. You're watching Your World at 10. Now, as we've been telling you, the RBI's credit policy today was far more dovish than what the street had expected. The inflation target for the end of the fiscal seems one that may be hard to achieve. Is the RBI falling behind the curve, or is that an extreme question? Well, to debate that, we have with us our banking editor, Latha, Venkatesh, Haseeb, Drabu, the chairman and CEO of Jammu and Kashmir Bank, and Sonal, Varma, vice president and India economist of Nomura. Latha, Sonal, and Mr. Drabu, thank you very much for joining us in the studio. It's a bit of an economic party here to have that many people talking about the economy. But let me start by synopsizing what we've heard from the governor, the FM, as well as many of the bank heads that you interacted with, Latha, today, that this increase in repo rates and CRR is unlikely to impact lending rates immediately. But if credit growth picks up, and the RBI's projection for the year is about 20%, liquidity will get squeezed, we will see rates move up. The RBI governor has quite predictably not ruled out midterm action, but he's also said that FY11 government borrowing may put pressure on interest rates. And the FM, and here's the final one, time to move back to neutral policy rates is what the finance minister had to say. So, Mr. Drabu, what do we make of the rate changes that are likely to happen over the course of the next 3 to 6 months, both from the policy front as well as effective lending rates, considering that they're not going to change immediately?
I think when you look at the policy rates, there's been some action today which followed earlier actions in the month. There is no doubt about the fact that we are seeing an interest rate regime of a different kind where you will see rising rates. Market rates at some point over the next 2 quarters will catch up. I expect market rates to react in the second and third quarter when credit demand picks up, plus private government borrowings is also completed, and you will see some of the impacts of the actions that's happened today. That's in terms of the broad stance of the policy. But in terms of the style of the policy that's happened today, I think what a 25 basis point hike across all three variants, reverse repo, and CRR, is a bit of a drip irrigation. You know, it's like doing it slowly, and again you would expect in 3 months' time to have some more rate hikes. But what this will fundamentally do is to create a certain uncertainty in the market, because for the banking sector as a whole, this in some way leads to preemptive sanctions, and people build up a position in sanctions, whereas no disbursements happen. If you look at it, the numbers today, the sanctions to disbursement ratio in banks is the lowest it's been in the last 10, 20 years. All this will bunch up credit towards the second and third quarter, and you will see a sharp rise, irrespective of policy action, in the second and third quarter of the current fiscal, when you will actually see a certain amount of sharp hikes in the market rates. Compounding that, again, you will have inflation with the spread now the governor is talking about. Again, markets will change. So you will probably see a greater degree of rise from now on than you have seen, the kind of calibrated rise that you have seen so far.
We've heard two very contrasting comments coming on inflation. The RBI's inflation projection for the year is 5.5%, but the FM today said that he expected inflation to trend closer to 4%. Much of this, I'm sure, will depend on how the monsoon pans out over the course of the next few months. But really, where in between is the inflation number going to come in, if at all it's going to be between 4 and 5.5? If
you were to take out the trend part, the noise in the data and the kind of effects of statistical database, you would probably be closer to the RBI estimate, though I think that even the RBI estimate is a bit of an underestimation at this point of time. There are a lot more imponderables, as you said, the monsoon being one, the oil prices being another, where the government will stick to the borrowing program that is done so far. It would perhaps appear that given the nature and structure of inflation that we have today, where it has spread from food to non-food, non-food inflation tends to be stickier than that of food inflation. So you'll probably see the rise was fast, but you will see the decline much more gradual than it is. So I would probably think it's a little more than what the RBI expects it to be, and nowhere closer to what the finance minister would think.
All right, so you called it drip irrigation, but Sonal, very interestingly in your note, you've said the tone of this policy statement was hawkish. Why did you think it was hawkish? Do you think it was more than you expected, or would you in some part subscribe to what Mr. Drabu is saying, that this will equal drip irrigation and we will see frequent policy action over the course of the next many months?
I think, people are disappointed because, expectations, particularly in the last 15 days, have built up calling for a 50 basis point on repo, reverse repo, and probably a 50 or a 25 to 50 on CRR, and particularly a 50 on the repo and the reverse repo rate. And I think one of the reasons why a lot of people are disappointed is because this 50 hasn't come in, which is why this policy has been sort of characterized as dovish. I think it is hawkish. I mean, the Reserve Bank has clearly said that inflation is the top priority over growth. That they are going to continue to tame inflation in the coming quarters. They've done a 25 basis point CRR hike. cumulatively, we've already seen a 100 basis point hike in CRR now. We've seen a cumulative 50 basis point hike in the repo and the reverse repo rate. And he said that this trajectory will continue. So it is a hawkish policy. I think, like I said, it's mainly that expectations had moved up quite sharply, and which is why it's being termed as relatively dovish.
So you're using both words, disappointed as well as hawkish, huh, Sonal?
Well, yes, disappointed. I mean, I think, one of the things that we've highlighted, and, we do think that, the Reserve Bank is falling behind the curve. Clearly, a lot of the policy normalization has to be done. And, one of the key messages that came out from the policy today is that the governor has underlined the word calibrated. And therefore, as much as we may want him to do a 50 basis point, which is what, they should do, what he's clearly said is that he's going to prefer to move in baby steps of 25 basis point incremental moves. So it is disappointing from that extent, in the sense that normalization is going to be quite prolonged. We know that policy transmission works with huge lags, and as we heard most banks today say, they are not going to react to the to the moves that the RBI has announced today. I think the bottom line from here is that don't expect any big sudden 50 basis point sort of moves in any of the rates. It is going to be very gradual, and therefore it's good for growth. It's good for liquidity, but obviously it's bad for inflation.
Latha, in that sense, is it good for corporate India because the increases are mild in sense and tempered, or like Mr. Drabu pointed out, it creates an element of uncertainty, and therefore it's really not that beneficial to corporate borrowers?
It's damn good in the short run, because you're not going to see even shorter term rates move up much, right. And therefore you're going to see corporate India rejoice. But my problem is that if you don't attack inflation effectively, like all the policy actions announced in the past 1 quarter have not resulted in banks inching up rates at all. If the bark doesn't bite, then you will not see people rethinking their intentions or rethinking their expenses. So in that case, it will not be able to rein in inflation, which is perhaps the primary reason why you are raising rates. But that may come back to hurt. If I may only interrupt you,
don't we need to factor in credit growth, which has been moving closer to the 20% mark as opposed to the 10% mark that we were seeing, in the middle of last year, as well as the government borrowing program that will kick in the first half of this year, and that will squeeze liquidity to some extent, right?
Yes, that government borrowing program has already taken the longer term interest rates to 8.5%, but people don't borrow at that level. What they would take is a 10-year loan, but set it at a 1-year interest rate and say we'll reset it. So immediately the cost of borrowing doesn't go up much, even if the government borrowing program pushes up the yields at the longer end.
But that's a good thing for corporate borrowers, right?
Well, it's good, but it will also lead to inflationary pressures continuing. I mean, if you don't put a brake on inflationary pressures or on the investment cycle soon enough, then it is possible that it will result in inflationary pressures staying on. And as Drabu was saying, you anyway see manufacturing inflation continuing. It's not very easy to cow it down. And if you continue with, exacerbating it, allowing people to raise money at a rate which is cheaper than it should be, the rate of interest should be in keeping with the inflation. If it is cheaper and you're borrowing at negative real interest rates, then it is going to fuel a kind of unsustainable, consumption. And that will lead to an inflation which could ultimately hurt growth altogether.
So would you agree, Mr. Drabu, that you would have preferred a big bang action in this policy as opposed to the drip irrigation strategy as you referred to it?
As I said, it's a matter of style, the conduct of the monetary policy and the style of monetary policy. Given the scenario that was pointed out in the policy, that was painted in the policy of a certain global kind of, where sovereign defaults, liquidity is now moving to sovereign defaults, quoting Greece, and the environment is operating, what I would expect is not so much a big bang, but firm, decisive policy action, which sends a signal right across and also gives time for that policy to transmit it across the system.
Okay.
A 25 basis point hike is not going to have an impact on inflation.
But we're still in the middle of a recovery. We've not fully recovered as yet.
I'm
so
not
you're
sure
sensitive.
if we are in a recovery in that sense. I mean, when you look at the numbers, it's not so clear. Recovery is tardy, it's patchy, it's delayed.
In which case, then this kind of sort of milder action should be better, or sort of more accepted.
I'm saying that if you need to fuel growth, it's better to have certainness about what's going to happen 3 months from now, 6 months from now. Today, I'm not clear if I'm expecting another policy action 1 month down the line, and that changes the entire pattern of lending and borrowing, which is not good for an environment like this. Markets must factor in. For instance, the last policy hike and even today's, the 10-year hasn't even moved an inch. It's even at sub-8 levels. So you're not really doing anything except using your MO to really, play to the market. It in some way feeds into the market. So in a situation like this, where you're very clear that we are now in a non-expansionary monetary policy,
right,
it has to be decisive, period.
Would your view change if we had a really good monsoon, okay, or a good monsoon, and if we saw that impact immediately on inflation numbers, and they trended more towards 4%, as the finance minister seems to indicate, then would you change your view about whether this policy should have been firmer, more decisive, bolder steps?
No, honestly not. Because you still, one is now, we're not going back to the same situation as the Indian economies of gamble on monsoons, but that, there are international pressures, there is domestic demand, there is a lot of issues internally which are structured in kind, which the monsoon won't resolve. So there is also an uncertainty in terms of the government borrowing program itself, which really is at the core of all this. Sure. With oil prices coming in, you don't know what that price would be. Asset prices are now looking very, very different. So in some ways, I think totality of it, it will probably ease the situation. You may post facto justify this action, but I would still bet for a stronger one-time corrective action.
Sonal, what do you think?
Well, I think it, that's entirely a function of how inflation pans out going forward. I mean, if you look at, the RBI has given out a clear inflation fan chart where it states how it expects inflation to pan out over the next, 12 months. Basically, it still thinks inflation hasn't peaked. The chart shows that it expects inflation to peak in June and start moderating from mid-2010 onwards. Of course, going to 5.5 by next March. But this peak in June is also somewhere, around 10, maybe 10.5%, not more than that. I think, a probable decisive 50 basis point rate action would be contingent on WPI and inflation probably moving up to, 12% in that handle. I think apart from monsoon, I'd also see what the government does on the oil price front, because under recovery there, as you know, it's running at more than 80,000 crore, and we are due for a one-shot adjustment in oil prices. I think if that comes in and if that is a big trigger to inflation, then we could see a much steeper hike. But as of now, of course, that is not the RBI's base scenario.
Mr. Drabu, last 20 seconds. When do you expect effective lending rates to start moving up?
Towards the later part of second quarter. It will also get affected by the base rate, which takes effect from 1st July. So you'll actually see an entire recalibration of interest rate. But like-to-like comparison, I would see it towards the later part of second.
So your banks are likely to hide it and disguise it as base rate?
Well, sort of.
All right, Mr. Drabu, Sonal, Latha, thank you very much for joining us. And that wraps up this edition.